Today we're going to dig into a really fascinating story happening in the medical tech world. It's about a company, Senseonics, that made a massive, and I mean massive, calculated bet on itself. We're going to break down what they did, why they did it, and what it all could mean for their future.
But first, you know the drill, a quick but important reminder, this is all for educational purposes. It is not financial advice. You've got to do your own research, all right? Let's do it.
Okay, let's just kick things off with the number that made everybody sit up and pay attention. A 72% jump in revenue, year over year in just one quarter. For a company in a space as tough as diabetes tech, that is a huge deal. So what in the world is going on here?
So here's our game plan for today. We're going to start with how this growth story kicked off. Then we'll get into the one huge bet they made by going in-house. We'll dissect what created that surge, look at what it costs them, the price of progress, and then peek into their 2026 outlook. And finally, we'll wrap it all up with the big investor takeaway.
So let's start at the beginning. Part 1. A growth story begins. This is all about those really impressive top-line numbers that set this whole thing in motion. And here is that jump in living color. Look at this. The last quarter of 2024, they brought in $8.3 million. Fast forward 1 year, $14.3 million. That 72% surge isn't just a random number. It's a signal that something fundamental, something big changed inside this business.
And you know, this wasn't just some lucky quarter. If you zoom out and look at the whole year, the story holds up. Revenue climbed from $22.5 million to over $35 million. So this tells us we're not looking at a spike, we're looking at a real, sustained acceleration.
Which, of course, brings us to the real question. Where did this sudden speed come from? Well, the answer lies in one single strategic decision that absolutely changed everything for them.
So here's the deal. Senseonics decided to take back control. For a long time, they had a partner, Essentia, that handled all their sales and distribution. But in 2025, they made the call to bring all of that stuff in-house. Now that is a massive, massive undertaking. You're basically rebuilding your entire sales operation from scratch.
And this wasn't some snap decision. The CEO, Tim Goodnow, said it himself. They were taking strategic actions to set up for long-term growth. In other words, this was a very deliberate move to grab the steering wheel and control their own destiny.
Okay, so they took control, but how did that actually translate into more money, more sales? Let's dive into the anatomy of this surge.
With this new control, Senseonics did something absolutely critical. They started talking directly to patients. They invested in what's called direct-to-consumer, or DTC, marketing. This let them just bypass the middleman and build a real relationship with the actual users. You know, for building a brand, that is a complete game changer.
And the results were, well, they were explosive. The number of new patients in the US literally more than doubled, a 103% increase from the year before. I mean, that's just crystal clear proof that their new marketing strategy was working.
And it wasn't only about the patients. See, for growth to last, you've got to have the doctors on your side. And right here, we see that the number of active prescribers, the folks actually writing the prescriptions, jumped by an incredible 80%. This shows they were hitting it from both sides, the patients asking for it and the doctors ready to prescribe it.
Now, as any investor will tell you, this kind of growth, it doesn't come for free. Taking back control and launching huge marketing campaigns costs some serious money. So it's time to talk about the price of all this progress.
This little table tells the whole story. Look at the top. Everything's great. Revenue is way up, gross profit almost doubled, but then you hit that third line, SG&A. That's your basic cost for selling and running the business. And whoa, those costs more than doubled. Because of that, the bottom line, the net loss, actually got bigger, going from a loss of $15.5 million to $20.8 million.
And seeing that SG&A cost as a bar chart really drives the point home. It rocketed from $8.9 million to almost $20 million bucks. Now, for any investor, this is the number that makes you lean in and ask, okay, where did all that cash go?
And the company's actually very upfront about it. This spending wasn't just random. Every single dollar ties right back to that huge strategic decision. They had to hire a whole new sales and marketing team. They had to pay for those super successful ad campaigns. They had higher commissions because they were selling more product. And of course, they had the direct costs of just taking over the business from their old partner. This was all part of the plan.
So they spent the money in 2025. And that leads us to the most important part for anyone thinking about investing. What's the payoff going to be? Let's check out the 2026 financial outlook. And the company laid out a pretty clear 4-step game plan. Steps 1 and 2, the big investments, led directly to step 3, all that growth we just saw. And the final step, step 4, well, that's the reward. They're projecting that for 2026, they'll unlock much higher revenue and, this is key, much better profit margins, because now they're in control.
And here's what that reward looks like. They're forecasting between $58 and $62 million in revenue for 2026. That's another huge leap forward, a 65 to 76% increase over 2025. This tells you they believe the momentum isn't just going to continue, it's actually going to get stronger.
Okay, now this might be the most important number of the whole story. The company expects their gross margins to hit around 50%. This is the big prize for bringing sales in-house. When you cut out the middleman, you get to keep a much bigger piece of the pie from every single sale. It totally changes the profitability of the business.
All right, we've covered a ton of ground. Let's pull it all together now and really focus on the main investor takeaway.
So what's the bottom line here? Look, Senseonics made a really bold move to control its own destiny. We've seen clear proof that it's already sparking incredible growth. And yeah, that growth cost a lot of money in 2025. But it's pretty obvious this was a planned investment, not a sign of some bigger problem. And looking forward, they expect that investment to pay off big time, with more growth and much, much healthier profits in 2026.
And really, it all boils down to this one question for anyone looking at this company. Do you see all that spending in 2025 as just a messy, expensive transition? Or do you see it as a smart, calculated investment to seize control of a market that's growing like crazy? How you answer that one question pretty much shapes the entire investment case.
And that's our deep dive on the massive pivot at Senseonics. If you like breakdowns like this that get right to the story behind all the numbers, then please do us a favor and like and subscribe for more.